During the month of July, the external sector of Sri Lanka showed a lackluster performance where the trade deficit continued to widen during July and a marginal decline was seen in worker remittances despite moderate growth in earnings from tourism. Trade deficit widened in July 2018, driven by higher imports which grew by 10.3% year-on-year to $1.8 billion in July, mainly due to imports of personal vehicles and fuel. The export increased by 5.7% to $1.1 billion, driven by the increase in petroleum products due to higher export prices for bunker and aviation fuel despite reduction in volumes. For the first 7 months of 2018, the overall trade deficit was recorded at $6.4 billion compared to $5.3 billion for the corresponding period last year. This was mainly due to the increase in imports of fuel, which grew by $530 million, personal vehicle imports, which grew by $517 million, and gold imports, which grew by $101 million. Tourism earnings grew by 6% year-on-year during July to $404 million, despite the traditional off-season period for tourists during the year. Meanwhile, balance of payment position continued to be stressed by the requirements of debt servicing and other financial outflows against moderate inflows during July 2018. The foreign exchange market continued to be under pressure due to foreign outflows from the government securities market. Foreign investment in government securities market recorded a net outflow of $53 million in July 2018, resulting in a cumulative net foreign outflow of $229 million in the first 7 months of 2018. Meanwhile, Sri Lankan rupee has depreciated 10.2% against the US dollar in the year up to 8 October 2018. For the same period, the Sri Lankan rupee has depreciated significantly against major currencies such as Euro by 6.9%, Sterling Pound by 8%, Yen by 9.4%. However, the Sri Lankan rupee was appreciated by 3.3% compared to the Indian rupee. The Central Bank of Sri Lanka is in the view that the currently observed exchange rate pressure is not limited to the Sri Lankan rupee, and any attempt to reverse such developments by supplying a large amount of foreign exchange from official international reserves would only lead to an adverse outcome. Instead, the central bank allowed market forces to determine the overall trend of the exchange rate, whilst intervening when essential to curb excessive speculation on the exchange rate. Thank you for tuning in and join us for another update next week.